Starting off with breadth in terms of advancing volume versus total volume. On December 26th, we had a 90% day. A 90% day occurs when 90% of total volume is actually advancing volume. In other words, advancing volume accounts for 90% of total volume. And then we had an 80+% day last Friday. Now, this is a recipe for some sort of a prolonged rally, okay? It's not a 1 or 2 day rally. It's actually one of two things, either resumption of the uptrend or a powerful relief rally in the context of a defined downtrend. So this is something that, believe it or not, I forgot to look at in the last few days until this morning when I was preparing some extra charts. I noticed, oh my God, we had a 90% day. To be fair though, reliable 90% days will have to come in pairs, okay? You can't have a one-off. Usually, according to Lowry Research, and those guys are the experts on that, you'll have to have a couple of them within a 2 to 3 day period. Now, one is good enough here. I've seen it. I've seen the market before resume its uptrend towards higher highs on a single 90% day, maybe a couple of 80+% days. It's not an exact science. All right. Now, let me switch over to Treasury bonds, or notes as they're called. Those are 10-year notes. So what happened with notes? Here's what's going on. The Treasury market was pricing in 2 to 3 extra interest rate hikes in 2019. It was already pricing it in. And then at the first sign of dovishness, it tried to unprice. First sign of dovishness, it tried to unprice what it has already priced. And that what happened then? Bond prices rallied. Yields began to retreat. And if you look at the yield curve right now, you'll see that there's no yield curve inversion. In fact, what you have is the 10-year and the 2-year moving more or less in unison, in concert with each other, in parallel. There's no 10-year gaining over the 2-year in order to cause an inversion. We came awful close though. It flattened pretty well actually. Now, similar to bonds, you have, or treasury bonds, you have corporate bonds. Those guys had to go to the market to borrow, and they found out that rates are high. They have to sell their bonds cheap in order to be competitive with treasury rates. But the moment we started hearing some dovish comments, and the whole bond market took some bearish, or began to have dovish overtones. What happened is corporate bonds reverse course. Upon reaching, by the way, look at the timeliness of this. We had a target back in October of 43.70 on SHYG, 43.63 at the most. We got to 43.84. That was close enough. And from there on, they reverse course. So timeliness, or as far as timing the market reversal, SHYG was impeccable. But it wasn't the only one, as I'll show you. Continuing on to the SPY. SPY right now, as of last Friday, retested or back tested the February lows. That was the February lows. It tested that endpoint. No big deal. It consolidated. It showed some weakness today at the open, very light weakness. Gathered itself and began to rally again. Where are we going? Same area. I would say more or less 261 is the underside of that 100-week moving average. That golden line right here is right above 260.47. So 261 more or less is where I'm looking for this to come to an end. And that is in agreement with what I showed you earlier when I wasn't still recording, or I wasn't showing the screen. I thought I was showing it to you. This is in agreement with the daily chart right here. This is 261. This is where our neckline happens to be, right around here. This red line here is the value area low for 2018. This whole auction right here is 2018, this whole red area. So we have a value area low of around 261. Same where the neckline is, and then you have a defined or confirmed downtrend per the direction of the 50-day moving average, okay? And so in a few days, this moving average will be right here, right where it's supposed to, where price is being, it's been drawn, or it's being drawn towards it as a magnet, and eventually we're going to consolidate, and that consolidation should prove to be a distribution leading to a retest of the lows, more or less. At least I think so. Okay, until then, we're long. We're long up until here. I'd like to go back to what happened here. We had a blow-off move right here in January. The 50-day moving average was upsloping. It was green. Prices trading above it. Technically, this looked good. And then we had that sell-off, which we timed to within 2 days, if you remember. I think January 26th when I said watch out. And we got that within a matter of 2 weeks. And so this move was so powerful, we sprung back, came down and retested. Now the 50-day moving average is red. So do you think it's going to rally back this way? No, it's going to try to regain its rhythm. And when it regains its rhythm, it left behind a triangle. From here, the triangle, price broke out above the triangle, came down, tested the 50, which was flat at that point, rallied towards the value area high. Sellers stepped in, sold it. Now we're below an upsloping 50. We're below an upsloping 50, and that is a recipe for a powerful rally. The moment the 50-day moving average turns green or begins to slope up, when price reverts to it and goes below it, you have the effect of a slingshot or a rubber band, and you rally big time. And that's exactly what happened technically if you were to look at nothing but the SPY and interpret the chart. So what do you think is going to happen right here? We're going to rally to the 50. Okay? It's down sloping, so they're going to sell into it because there's so much resistance right here. You have the value area low, the neckline, you have the 100-week moving average, and you have the down sloping 50. And now you're going to probably consolidate a little bit, come down, test maybe a little lower, do this. All this is accumulation that will eventually lead to a breakout. In this accumulation, you have the weak hands selling into the smart hands, the institutions. You know, the smart ones are buying or accumulating shares as the small guys panic on every move. And that's pretty much what happens every time the market sells off. So it finds its rhythm and then boom, it eventually rallies. So I'm expecting 2019, especially the second half, to look really great. But the chart will have to repair itself, and we're going to have a moment this year. There's going to be a time when something very similar to this will happen. The 50-day will begin to do this. You know, eventually all these powerful rallies will cause the 50-day to turn up, and then we're going to rally towards it, maybe above it, come down, test the neckline below it, and then rally big time. And we're going to try and catch all these moves, or as many of them as possible. Continuing on, I'm going to talk about the ES and why I strongly believe, despite all that powerful activity, that this is a relief rally in the context of a confirmed downtrend, because most of the indices, if not all, have sported an ABC rally here. This I thought was wave 4. But it turns out that this relief rally isn't wave 4, it's something else. It's a relief rally whose goal is to test resistance. So it's a mean reversion move. What emboldens me even more is the fact that this, in hindsight, was an expanding triangle. And this expanding triangle has a wave E that broke temporarily or momentarily below the AC line. And the reason it does that is what gives it its nickname, the emotional wave. E is for emotional. So when that happens, you sort of know that, yeah, that was an expanding triangle, and those expanding triangles, believe it or not, they don't happen that often. They don't happen nearly as often as, say, a symmetrical or contracting triangle or an ascending or descending triangle. It's just whenever I see this, now there are implications to the fact that wave X is a triangle, and I'll tell you that. I'll tell you what in a second. So on the heels of wave W, the zigzag ABC, we had a 5-wave expanding triangle, which we label wave X. And now we have wave A reaching about 256, 257, I think, on the SPY, of course. Same pattern on SPY or ES, doesn't matter. And that wave A is going to give way to wave B. I don't know the extent of that wave B, maybe 250, 252 on SPY. And then wave C to our the target, C. C will end, wave C will end, wave Y, and in hindsight, I'll figure out what the chart should look like from a price structure, from a wave structure, I mean, how I should label the whole thing, and that is the least of my worries, to be honest with you. So this relief rally, once it ends in an ABC X ABC or WXY, should at that point give way to a retest of the lows, possibly a breach. What's going to catalyze this? What are the reasons behind that sell-off? Certainly not bonds. I don't think so. Certainly not the economy. It's got to have to be something else. It has to. Government shutdown, dysfunction in Washington, border wall, trade wars, impeachment. There's no shortage of excuses. But with every one of these, there will be an opportunity to accumulate shares. And that's what the smart money, the institutions will be salivating to do, actually. I recall one time in 2011, sometime during the summer after the August sell-off took place. I believe it was sometime in September maybe or late August. Anything anything that anything negative, anything that had a negative undertones, anything that had a negative undertone to it, led to a sell-off. Temporary, but the market reacted to it. One of those things was, believe it or not, a nuclear plant in south of France experiencing, it's a waste management plant, by the way, experiencing some little hiccup or something like that. And then you had a little earthquake somewhere else, and the moment the market hears something like that, they panic and they press the sell button. And that's what happens when volatility is high. Anyways, once this thing SPY gets around 261 or so, I think we'll reverse course, and maybe then we'll end the bear market upon a retest of the December lows and possibly a breach. And I believe it's probably going to be a breach that is convincing enough for a lot of people to press the sell button. Because after all, as I said earlier, the market is nothing but, conflicting or differences of opinions. Now, here's the same thing. This is the Qs, by the way. This is before the open. We got to the neckline, believe it or not. But if you look at what happened last Friday, and this happened, of course, on both SPY and QQQ, that Thursday sell-off was a flag. That reaction to Apple's announcement left behind a flag, a bull flag. The measured move of this bull flag is the downsloping 50-day moving average. So again, this is a mean reversion move. If this is truly a head and shoulders, shoulder, and you have the weak shoulder here, and those usually make for very potent patterns. This here, we should be really here. The correction should end here somewhere, not here. Now, the reason we bounced off this level, believe it or not, is because when on December 24th, we tested the 2017 volume point of control, that was good enough for the market to book profit or to book the short positions, close the short positions and buy. In other words, it was an excuse to buy and for the shorts to cover their shorts. That's what I'm saying. So it was technical. It was a very convenient place to press the buy button. All right, next is the NASDAQ composite. Now, very interesting pattern here, okay? A lot of interesting things about this chart, actually. I'm going to use a different color here. I'm going to try and use yellow. Since 2000, we have been forming a massive cup. And one of the ways I timed the top of the market in 2015 is, and I said that ahead of time, because I had been tracking this pattern since 2013, right around here. And took advantage of all this, and I said when we get to the prior high, even though a lot of stocks that existed here no longer exists here, all those dumb stocks that promised the world and went public and didn't really amount for anything, technically, you reach a prior high, it's time to sell. And so I even said how this is going to unfold. I said we're probably going to test or back test the channel, that gray channel, okay? And that's exactly what happened right here. It was an ABC, a corrective pattern. That corrective pattern is really nothing but a handle. So you have a cup and a handle, And when we broke above it right here, I said, we're probably going, you know, towards 76.19. That was my target, 76.19. Since 2013, it was 76.19. We got to it right here in February. But there was something funny about the rally from this point, is that we had a wave 1, we had a wave 3. I didn't see a wave 4 and 5. So that's why I kept telling you that there's a very good chance another high, a sucker high will take place. And that's exactly what we got in September, last September. And of course, there was a lot of doubt along the way. One day I'd say, no, it's it. One day I'd say, no, I think there is another one. I finally came to the conclusion that there's going to be another one. And, you know, from day to day, things happen to make you doubt what you believe in. Anyways, what I really, truly believe right now is that this fourth wave, this correction is not over. It probably needs to come down here some point. So this is the prior low. This is the low of December. We're probably going to rally and come down, breach it, and swiftly reverse course. Okay? Coming to think about it, the market loves simplicity. And one place it might end this is, you know, somewhere here. Third touch, bounce off that trend line, and then rally. We'll see. We'll get to that bridge, or we'll jump off of it when we'll jump off the bridge when we get to it. Anyways, that's the ComQ. Now, there's something really cool about this, and you never ever hear anything say anything about it. 2009, we never really breached the 2002 lows. In fact, wave 2 here retraced 88.6% of wave 1. So really, the bear market ended in 2002 for the NASDAQ. Okay, different indices begin and end their bear markets at different times. They don't all have to move together because they contain different constituents, different stocks, different risk profiles. Some have well-established stocks, others have risky stocks. Some of them are capitalization weighted, other ones are not, so on and so forth. So anyways, the NASDAQ, and that's an index of 3,000 stocks, so you ought to believe what it's telling you. The new bull market began here in 2002 for the NASDAQ composite, not 2009 like the media and other people tell you. So we had wave 1, at least for someone who uses wave theory. That's wave 2, and now we've been in wave 3. In fact, depending on which wave interpretation you like to use, the classic Elliott wave or the harmonic, at least wave 3 or wave A of 3, meaning half of wave A, is going to end right here. The measured move of this cup is 93.55. I'm sorry, it's 96.18. The measured move of the cup is 96.18. 93.55. Again, I'm sorry, I'm confusing them. Anyways, the measured move, let's call it 93.50. How about that? And that 93.50 area coincides with the 461.8% move in wave 3. So if this is yellow wave 3 getting to here, its size will be 461.8% the size of wave 1, meaning almost 5 times. Wave 5 is 5 times almost the size of wave 1. And this is a Fibonacci projection, of course. Okay, so that is ideal for the next bear market to begin from around 93.50 on the NASDAQ composite. So keep that in mind. That's going to be an amazing thing. What will happen afterwards, I'm sure, more or less. I mean, I'm confident. I'm never sure because nothing is for sure, is we'll come down and retest the fourth wave. So that's going to be a heck of a correction right here. Huge. That will definitely be called a bear market. But until then, I think we're going to come down here and rally to this in the next 2 years. In the next 2 years. All right, again, I don't have a crystal ball. This is my thesis on it. No one has a crystal ball. And we certainly don't trade based on what you're seeing here, because from day to day, week to week, month to month, anything can happen. You just trade the market in front of you, trying to be not too, trying not to trade too short of a time frame, and try not to trade too long of a time frame. Somewhere in the middle, 30 to 60 day outlook, especially when it comes to options trading. 60, 90 days is fine, but anything 30 and above. Now, moving forward, this is the NASDAQ Banking Index. Now, this thing reached, use pink this time. It'll show a little better with so many colors on the screen. Here's where we got to, point B, almost. So if there's one particular index that might have already put in its low, maybe it's the financials. Okay, because they really overdid it. They really overdid it. I thought this right here would be the end of the correction. No, we overshot. Okay, so now will those guys be the greatest opportunity for the next 2 years? You know what? I don't think so. They're not the best opportunity. They will give you a great opportunity up to right here. Okay, 1.618 4867 is the 1.618 XA of this crab pattern, harmonic crab. It has a target of 1.618 XA, and the crab pattern is notorious for the violent reversal. But it's also famous for retesting the highs before eventually breaking down. So I think the first sell-off could be down to the lower boundary of this, what do you call it, the potential reversal zone. This is the range for this pattern. We got right in the middle of it. And actually, the target was almost ideal. This is where we got to. That was my target right here. 61.8% the projection in wave 5, purple wave 5, meaning 61.8% the size of wave 3 starting at 0.4 or wave 4. This here, the size of this move is 61.8% the size of this move. And we got there, I mean, we were within, I don't know, a few points, basically, a few points. It was incredible that this whole market plays out like this, which begs the question, is the market really a random walk? Because there's definitely an invisible hand that that draws these elegant patterns. All right, moving forward, you got the Dow Jones. Let me tell you, I looked at the indicators, the momentum indicators configured or optimized for Elliott wave forecasting. And on the momentum, on the monthly chart, on the monthly time frame, that wave 4, momentum is supposed to wane, and the market has, all momentum has to dissipate out of the market for wave 4 to end. And the momentum, even though I'm not showing it here on this chart, is nowhere near zero yet. It has not yet completely dissipated on the monthly chart. So I think what's going to happen is once we once the relief rally has run its course, we're going to come back down, back test the yellow channel, similar to how the NASDAQ Composite back tested its channel back in 2015, 2016. And it's not, I didn't choose this point conveniently. It just so happens that the 38.2% retracement and the top of the channel intersect right here, somewhere in June. Now, could we come back earlier than June and test it, maybe go below it a little bit? Could we wait past June, or, could this be deferred to, say, July, come back down, breach the channel, and turn back up? Sure, anything can happen. But it seemed interesting to me, in the least, that these 2 points coincide right here, right around June 2019. By the way, after that, once wave 4 is done, the Dow, the Dow will rally from that 21,000 area. It will gain actually over 50%. So ideally speaking, okay, we'll revise these targets as things begin to turn, and as we need for wave 4 to be confirmed, first of all, at some point, and for signs of a lasting reversal to become evident. And then as price progresses over the next coming months, we'll be able to better judge or estimate the extent of wave 5. But remember, I'm not looking at things in the vacuum. I'm not looking at just the Dow. I'm not just looking at this S&P. I'm not just looking at the QQQ. It's this basket of things, this holistic view of the market, looking at a whole bunch of different things and looking for synchronicity among them. Okay, things have to lead you to a consensus. You cannot rely on one particular approach to technical analysis and put all your eggs in one basket, or hang your hat on just one thing. You have to use different approaches, different disciplines, and try to come to a consensus on what the market is likely to do over a certain period of time. So that's why anybody who uses just one approach is doomed for failure over time. They could strike it big one time, but the next 5 times, forget it. And that's why the folks from Elliott Wave, for example, those guys who use just one main approach, basically their Elliott Wave count, or Glenn Neely, who's got Neo Wave, all these guys are more often wrong than right. Glenn Neely called for the end of the bull market in 2015, and now he made a call again that the bull market since 2009 has come to an end. If you go to ElliottWave.com, those guys are now celebrating the end of the bull market as well, but not us, not us. The Russell 2000, what a great ending point right here, right upon reaching this line right here. Now, we had support right about here, the 50-month moving average, maybe the 200-week moving average if you look at the weekly instead of monthly, I don't know. But if you remember, the S&P reached the 200-week moving average, if I'm not correct, which happens to be right around the 50-month moving average. I said right around 233, 234. This is where you cover your shorts and you expect a relief rally. The only problem is that we didn't take advantage of that rally. But we're trying to make up for it right now. Anyways, there'll be a much more powerful rally in the coming after that next leg down. And that next leg down hopefully will time it to perfection. The Russell, though, this pattern right here, a rising wedge, and it's actually a broadening wedge because the two trend lines are divergent. If we get that fourth wave to come all the way down to 50%, because this was technical right here. We almost got to it, by the way. You know, what is this? What is this compared to this? You know, so all the indices, or a lot of them, are going to finish rising in mean reversion fashion, come down, put a final low. And the beauty of the Russell is that it's giving you a beautiful pattern. If you look at chart pattern recognition, you'll know that the third touch on this pattern is your buying opportunity. The third touch is your buying opportunity. In fact, this happened in 2009 on the Dow Jones right here. Now, this wasn't a broadening wedge. It was a right-angled broadening formation, okay? Same kind of thing, believe it or not. But that third touch right here, it was a head fake here. That was panic below that line. And boom, we reversed course, never to look back. Now, you know what's so funny? You remember all the panic of 2010, 2011? That's what they are right here. They're like little blips on the radar compared to this. But everybody remembers them. Everyone remembers this, those two sell-offs here that look minuscule compared to what happened afterwards. And everybody's waiting to take advantage of moves like this instead of moves like this, which is crazy. This is the Russell. Actually, that was INDU. Okay, this is the Russell that I was talking about. So wave 5 is probably going to take us up to that same trend line to end wave 5 near 2036. And I believe this point happens to be 2021 also. So it agrees with the other chart I was discussing. What was it? Was it the S&P or the NASDAQ? I forgot. But we have a target of January 2021 as the end date for the next bull run. We'll see if this pans out. Next is the SOX. The SOX actually exhibited a behavior reminiscent of 2011. Why? Because its high came in early 2018. And even though the other most popular indices that everybody talks and watches forged ahead and made new highs, this guy here, the SOX, made lower highs. And it ended up creating a triangle, right? So this is really a Wyckoff top. We call that a Wyckoff top after Wyckoff, a famous chartist and trader. I don't know much about him. I don't read much, believe it or not. So the measured move of this triangle, and I don't care about the triangle itself, but where is support here? I outlined the support area as being anywhere between 1070 and the fourth wave identified right here. That's I think this happened 2017, summer 2017 is where that low came, that little tiny wave 4. But it's very possible that the SOX has already done its thing because it came down and hit TDST right on the head, right here. What is TDST? TD stands for Tom DeMark. TDST is a support line that you draw from the lowest point within that 9-bar series, the one labeled in black. Now, what makes bar number one? What are the qualifications? The first bar to close above the closing price of 4 bars earlier. This one right here. That was the first time we closed above the closing 4 previous bars prior. In other words, this one closed below this one closed below this one, so on and so forth. Not until this rally happened did we get a close that is higher than the close from 4 weeks earlier, because this is the weekly chart. So 4 weeks earlier, we closed right here. And now we finally closed above that. And this is indicative of a trend reversal. Wave 1, now look at wave 2. Wave 2 was such a, I'm sorry, not wave 2, bar number 2. It actually left behind a bearish harami. It made everybody think it's a bearish harami and we're heading lower. Certainly not. What happened is kind of what happened last Thursday, Friday, when we had a weekday on Thursday, and then we came back and the market came back in with a vengeance on Friday. So this is what took place here, bar number 9. When you get to 9, it tells you that momentum is really on the side of the bulls. And then we got the choppiness, and finally we got to blue number 13. This is called DeMark Sequential 13, or TD, Tom DeMark, TD Sequential Sell Signal. And it's funny that it happened right where it was supposed to happen, right where wave 5 reached its maximum potential, or almost did it, because that was the target range for wave 5, or purple wave 3, or wave 5. Is 61.8% to 76.4. So we got to that range while registering TD sequential sell 13. After that, for the rest of 2018, it was a series of lower highs. And so it's possible that wave 4 is over. Or maybe we're going to rally, I don't know how far, come down and actually test 38.2%, meaning wave 4 reaches 38.2% retracement of wave 3. So it'll be a nominally new low to scare everyone and then rally back for good. We'll see how it goes. But listen, mark my words, in the next few months will be a lot of ups and downs. Sell the rallies, buy the dips, and those who actually sell spreads above and below resistance and support will probably be the most rewarded of all. This is also the SOX, but on the monthly chart. We were talking about weekly here to pinpoint the formation, the Wyckoff top, the triangle. But look, what do you think this is? If I were to look at this on the monthly instead of the weekly, what is this really? What this is, it is the handle that goes with the cup. The handle that goes with the cup. And if I'm right, wave 5 is going to go towards 1800 to 2000. So this thing will almost double. That's why the semiconductors would continue to be a better alternative to, say, financials. But of course, institutions diversify and they rotate in and out of sectors and markets and asset classes, whatever you want to call them. But you know what this is, right? This cup and handle lends itself, or I'm sorry, reminds you of what? It reminds you of the ComQ chart right here. It's the same exact thing that happened on the ComQ back in 2015, 2016. That's happening now on the SOX. Same exact thing. Cup. So, oh, did I just draw? Oh, that's the ComQ. So the same exact thing is happening right here. Cup. And a handle. Identical pattern. And last but not least, the transports. 38.2% retracements of wave 3. By the way, I'm not showing all of wave 3. It extends way past that. Wave 3 really began in 2009. And the rally from 2016, 15, 16 up until now is the second half of wave 3. The first half of wave 3 ended right here. This is wave B of 3. And the prior rally, which is equal in size to this one, began in 2009. Actually, I'm sorry, 2011. Wave 1 began 2009, wave 2 ended 2011, and then 2012, wave 3 began, had a little bit of correction right here in wave B, and then wave 3 ended this year, last year, 2018. So now we are in wave 4, with wave 5 anticipated to take us well above the prior high to I don't know where exactly. Last time there's always an ideal target, one that you would derive from reading textbooks, and you have the actual target, which you have to time with respect to unfolding events, so on and so forth. Okay. Anyways, that's all I got for this presentation, which is in effect a live edition of the monthly outlook that I've been publishing as an article. I figured that I would give this a try to see how much better you guys would like it. In other words, instead of sitting there reading and clicking on charts and trying to make sense out of what I'm saying, it would be a better experience to deliver the monthly the monthly outlook in a live interactive session. So if you guys like this, we're going to continue doing it, because to me it's actually more enjoyable, and it's easier, less stressful, because for me to write an outlook, which seems like, and every time someone asks me a question that they could have read the article and found at least one reliable answer. It tells me that they didn't read it. They didn't really read what I just worked on for several hours. It takes me about 5 hours. It takes me 1 hour to put the charts together, another hour to make sense of them, and a couple of hours to actually write the article. But if I do it like this, in interactive fashion, it would take me an hour to capture the charts, and then about an hour to present it to you. And if you feel that this is a better approach, a better way to deliver the monthly outlook, please let me know, because that's the way I want to go from now on.